What's up, everyone? It's Caddy with Money Vest. I am sorry I am late. I was busy. I literally just got back home. I'm sorry, right here. There we go. Now you should be able to hear me now. And again, as I was saying, I do apologize. I just got back home. I was a little occupied elsewhere, but we are ready in less than 20 minutes. We're gonna get the Fed statement on their website. So this right here is going to be the website. Again, you can go check it out. And of course, meeting and calendars. We're going to get the summary of economic projections at 2 p.m. Eastern. That is less than 20 minutes away. We're going to take a look at the market's reaction. Right now, we've got the SPY. Very, very flat, not really making any moves. We've got the NASDAQ here, ticker symbol IXIC, also very flat, down about 21 basis points, and the Dow Jones also very flat, about 0.5% higher. Now, what I want you guys to do is basically go to the live stream and hit share and share it with people that you think might be interested in joining us, okay? Whether it could be friends, family members, whatever it is, invite everyone because this is going to get really, really interesting. Just let me know the audio and the video. Just want to make sure that everything is crisp and clear and you guys can see the screen, you guys can see me, you guys can hear me. Just want to make sure that there are no difficulties, there are no problems. And yes, Jay Powell is going to be speaking at 2:30 p.m. Eastern. And we did actually have Tesla rally quite a bit. I did look at that. So at 12:50 p.m., we did see Tesla rally over 2% and pushing higher. It's not clear exactly why that move happened. I'm sure there's definitely a reason for it. But like I said, I just checked in and I just looked at this chart. And obviously, it did rally from 265, a little bit over 3%, now trading back over $270. But Apple obviously still down 1%. We got Microsoft down close to 1%. Nvidia is down close to 1%. So Tesla and AMD are the only two names that are pushing higher. Google, Apple, Netflix, Microsoft, everything is selling off a little bit here on the day, with Cart down 6%. And we talked about Instacart in our yesterday's video. The IPO price was way too high at well over $40 per share, I think. That's where it opened and that's where it IPO'd. That was definitely a little too high for me, $42.95, so $43. And I mentioned like anything sub $30 would be worth considering. Right now, it's still a little bit over $30 at the moment. Of course, ARM Holdings is also selling off here on the day. I think it's down a little bit over 2% last time I checked, but pre-market, as soon as this thing loads up, I don't know why it's taking a little too long, but Enphase to the moon. Yes, so Enphase is pushing higher. It did a really good job in pushing up. So there we go. ARM Holdings now is down over 3.6% at the moment. And Enphase, on the other hand, seems to be outperforming the market, right? That's actually quite interesting because yesterday it pushed higher. Enphase today is up another 3.5%. I did a video on Enphase earlier today. Make sure that you do check that out. So don't skip on those videos because they definitely do have a lot of insightful information. Of course, have a lot of value in terms of the catalyst. We learned that there's a director insider actually did buy quite a bit of Enphase shares. And this week it's up over 5% when the markets are down. So we are seeing a significant outperformance on Enphase relative to the market right now. So I hope you guys are ready. So in less than 11 minutes, we are going to get the statement, the SEP, and of course we have the FOMC conference at 2:30 p.m. Eastern. That's when it's actually going to begin, and that's when our very own Jerome Powell is going to come online and of course talk to us about the rates, about the potential hikes, and of course we're gonna listen in on all of those. So Parrot, I will be looking into industrials as well. They have great cash flows. The stocks you review are always tech centered. That's not true. I mean, we have covered energy stocks. I did a video on energy companies a couple days ago. We talked about Exxon, Chevron. We talked about Devon Energy. And then we've also talked about a lot of other, staple stocks. We've done videos on Target, CVS, Walmart, Walgreens, all these companies. I mean, there's a lot of companies that we have already analyzed. But yes, industrials, if you have any companies that you want me to go over, I'm happy to, analyze those as well for you. But like I said, guys, do me a couple favors. Drop a like on this live stream. It really helps push this live stream out to other people. YouTube's algorithm really pushes this out to other people so more people can join us. And also do participate on the poll right now. We're at 76 votes. We've got less than 45 minutes in the speech to actually getting started. And I want at least 300 votes by then for us to better understand what is going to be that tone from Jerome Powell, whether it's going to be hawkish, dovish, what's going to be that tone, right? In my opinion, I think there's going to be a pause and a hawkish tone from the Federal Reserve Chairman Jerome Powell, where he is going to guide for potential. They're going to keep it open, and we're going to talk about all those things. I've got a lot of work to do here, but let's see some of the questions here. Caddy, are you checking the private chat on a day-to-day basis. I am, Vault. Is there anything interesting that's going on? I am. For the most part, I do browse through a lot of the chats here. But of course, I haven't participated a little bit, but I will definitely. But let me know if there's anything interesting going on in there. I'll definitely check. But anyway, so going back over to the summary of economic projections, we're also going to go open up the CME Fed Watch tool to understand what the market's pricing in. We already know it's over a 90% probability that the Federal Reserve is going to pause interest rates at this meeting. And again, 8 minutes and 40 seconds is the next meeting, right? So it's going to be the statement, the SEP. And right now, of course, we know 99% probability that the Federal Reserve is going to pause. There's one more thing that I want to look up here. So just give me 1 second. Hopefully I can find it because, I did this. Here, let me just change the camera here. So I did this analysis on the different scenarios, right, and different things that the Federal Reserve is going to announce. Where did I put that? Here, let me see if I can find it. That's really important. Very, very interesting sort of because there's three things, right? Three things that we are going to be focusing on when it comes to the Federal Reserve. That's the rate hikes in terms of, whether they're going to be doing the rate hike itself, the rate decision. And then we've got the 2023 and 2024 expectations. So that's going to be this over here. Let me just open that up. There we go. So this right here was something that we were talking about in one of our previous videos. And these are the three things to really be focusing on, right? And I'm just going to take a quick check on the markets very quickly. So we got the S&P 500 flat, NASDAQ flat, Dow Jones flat. When it comes to individual stocks, Tesla's still up over 1.86% mysteriously. Everything else is down about 0.5% to 1%. Quick check here. Perfect. 2 likes, 152 people watching. Yeah, guys, make sure that you drop a like. I would really appreciate it. So, Infamous, if you don't want to get banned, don't just throw in some ticker symbols there. Please make sure that you are respecting other members and other people and, give them an opportunity to type in as well. Otherwise, I'll have to obviously get rid of you. So, don't do that. Do you think high interest rates are stimulating the economy, especially when the public has so much in savings? Seems like everyone is still spending because they are making so much interest. I think the savings rate is starting to deplete pretty aggressively, and we already know the excess savings are already gone. For the most part, they've gone from like $2.1 trillion to now pretty much nothing. And we know that the other savings that the consumers have when it comes to retirement accounts, 401ks, pensions, whatnot, they're going to start to deplete and run out in May of 2024. So I think the spending has been strong, you're right, on the back of these excess savings. But now we know that credit card debt's been going higher. We know that credit card debt is at an all-time high at well over $1 trillion at the moment at a rate which is over 26%. So those are pretty significant numbers. I actually took a screenshot of one more thing. Let me see if I can bring that up because that was on CNBC earlier that pretty much mentioned the change in interest rate or change in the borrowing rate for there we go. This right here is what I'm talking about. So this is the borrowing cost among investors, among consumers in the last 12 months since Federal Reserve has started raising rates. So the 30-year fixed rate mortgage has gone from like 4.29 from March of 2022 to over 7%. That's a 300 basis point change. The credit card rate has gone from 16% to over 20%. Personal loans, right? 5-year personal loans fixed 12.63 to over 20%. That's a 750 basis point increase in just 1 year, a little over 1 year. And we've got, used cars and new car both increasing 200 basis points going, from 5 and 9% to over 7 and 11% respectively. So, when rates are this high, you're definitely going to start to see some pullback in overall loan activity, loan volumes. That's exactly what we have witnessed. But at the same time, people have no choice, right? Savings are starting to come down. Inflation's still pretty elevated. So what are they going to do? They're going to start tapping into some of these lines of credit in order to basically, continue living, continue to do what they want to do, right? So credit card spending is higher. So I do think that there is going to be a little bit of a ripple effect eventually in the fourth quarter. I do expect consumers to pull back. They already are, right? We looked at the surveys and they already mentioned that they are pulling back on their spending, and over 90% of consumers have already started to shift towards only essential item spending, and they have kind of foregone any non-essential item spending as well. So that is something to keep in mind. Okay, Yeah, so I will get to that tag vault. I will definitely get to it. And let's just quickly go over some of these things, which I think are going to be important for us to look at. So when it comes to the rate decision, this is my sort of expectations, right? So obviously we know that there's not going to be a rate hike this meeting. It's pretty much a done deal, over 99% probability, which is what the market's already pricing in, right? And by the way, what do you guys think? What scenario are we going to have with these three things? I want you guys to comment. So structure your comment in a way that takes into account both the rate decision, all three things: rate decision, guidance for 23, and guidance for 2024. So what combination do you think we're going to get between the SEP and between the rate decision? Quick, we've got 4 minutes, right? So what you need to do is basically take one from here, one from over here, and one from over here. And then I'll tell you mine. So in my opinion, no hike this meeting, right? So that's expected, neutral. The guidance, I think they're still going to keep one rate hike, which is what they penciled in the last SEP, right? So they're expecting at least one more hike. I think that's what they're going to put in. I think it's going to be a close call in the dot plot, right? Dot plot's going to be very, very close. They're going to keep it flexible and open to one more potential rate hike. And then in 2024, I think it's going to be, I don't know, for some reason I feel like they're going to keep 3 rate cuts instead of 4. That's what the market's pricing in, is 3 rate cuts. Instead of 4. 4 is what the Federal Reserve's penciled in their SEP, and 3 is what the market's pricing in. And that's why I've got both as neutral, as expected. Anything less than 3 rate cuts, I think it's going to be bearish, because that's going to tell the market that the Federal Reserve is not really planning on cutting rates even in 2024. They are, but maybe less than 3, right? 2 or less than 2. If they see rate hikes in 2024, then it's game over, right? Then they're expecting more rate hikes in 2024. But if they see 5 or more rate cuts, then I think that's going to be very bullish for the market. So again, we'll find out in about 3 minutes here. 3 minutes. And we are going to see the statement from the Federal Reserve. We're going to keep the markets open here. S&P 500 flat, not really moving. NASDAQ flat. We've got the Dow Jones flat. So that's perfect, because that's going to give us a good reaction from the market, because we're not really higher or lower. We're just baseline flat here, and we're going to get those numbers in 2 minutes. 2 minutes, folks. 2 minutes. I'm going to continue to reload this page. And as soon as this thing pops up, we're going to take a look at both the PDF and the SEP material over here. So the first thing to look at is going to be the PDF. We're going to quickly eye into this line, which is going to tell us the rate, whether they kept it as where it is or if they increase. If they increase, man, then the hell's going to break loose if they increase by 25 basis points. I think that is going to be brutal. But I don't think they're going to do that. 99% probability. How the market cannot be wrong. They can't be wrong. 99% is pretty high. So, okay, we're almost there. We're almost there. About 1 minute, 60 seconds till the report come out. I'll quickly be, kind of switching back and forth between how the market's reacting to what the Federal Reserve is reporting, both from a statement standpoint and from an SEP standpoint. The reason why this meeting is so important, because we've also got the summary of economic projections. We haven't received that in 3 months. Since June, right? So July, August, and now it's September. All right, 30 seconds. 30 seconds, folks. Drop a like, vote, comment. All right, here we go. We are ready. We are ready to see what the Federal Reserve has in store for us. 15 seconds. All right, let's see if they have that already. I'm just going to reload. All right, nothing yet. The market definitely is moving, going down a little bit. Nothing yet, nothing. There we go. Perfect. So PDF. First things first. Okay, they kept rates the same. No changes in the rates. Now, when it comes to the SEP, very, very quickly, we've got unemployment, 3.8. Interest rates, wow. See, that's what I thought. Fewer rate cuts. Folks. In 2024, they're expecting fewer rate cuts. That's not good for the market. They're only expecting 2. They're only expecting 2 rate cuts in 2024. That is crazy. That's basically coming down from 5.6 to 5.1%. You see how that's been updated, right? So if I just highlight that very, very quickly, this right here is exactly what I'm talking about. The market's not going to like that because that's basically expecting fewer rate cuts. So again, you can see 5.6 to 5.6, that's unchanged, right? They're expecting, one more potential rate hike. Now, this is where things get interesting. 2024, they're now expecting 5.1% as the terminal. You can see the market's reaction. That's pretty obvious because, as I mentioned in here, if 2024's is fewer rate cuts, right? I specifically mentioned this in my other video. If there's less than 3 rate cuts in 2024, that is going to be bearish for the market because we are expecting 3 or more. And if they come in, put literally their hands down, they're like less than 3 rate cuts, they gave us 2. Market's not going to like that. And right now we're selling off a little bit. Let's just take a look at the dot plot very quickly. So, wow, majority of members expecting rates to be above 5%. 5.5, actually 5%. So we got 4 plus 4, 8, 9, 10. 10 to 9. 10 to 9 majority. So we are expecting over 10 members expecting rates to be over 5% in 2024. That's actually quite interesting. That is quite interesting. A majority of members expect at least another rate hike this year. And it wasn't even a close call. So that was expected by a lot of people. That is going to be a close call, right? Majority of people expecting rate hikes was not something that was expected. But right now we got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. 12 members against 7. So that was definitely majority move for one more potential hike in 2023. See, that's what I've been saying for such a long time, that I feel like the Federal Reserve has maybe one more rate hike left in them. They definitely have one more rate hike left in 2023. And that's what it seems like they're going to do. Like majority of members expect 12 members against 7, expect one more potential hike. But the real catch comes in 2024. That's really what kind of shot us down on the S&P and the NASDAQ is the increase from 4.6 to 5.1%. When it comes to inflation, nothing changes. 2.5 next year, 2.2 the year after that. This year, they're expecting 3.3. For core, they're expecting 3.7, 2.6 next year. Now, what is going to be interesting, a question is their inflation expectations have come down. So they've gone from like 3.9 to 3.7%, right? And next year's unchanged. So why fewer cuts, right? That's going to be a big question. I think that's going to be asked in the meeting. Why fewer cuts, right? By the way, everyone, if you guys can see me, hear me, I just want to make sure the audio and the video is good, right? So please just give me a thumbs up. Let me know if everything is working well and there's no lags. I just don't want anyone to miss out on the information that we're talking about. But for people joining us right now, no rate hikes. So the Federal Reserve kept the rates exactly where they are. So they said in support of these goals, committee decided to maintain the target range of the federal funds rate of 5.25% and 5.5%. So no rate increases as expected. But the bigger blow to the market came in with the fact. So what did we witness over here? I'll highlight exactly what we witnessed, right? So what we witnessed with the SEP was no hike, right, as expected by the market. We also got one rate hike as expected by the market by 2023. But this right here was the bigger deal in 2024, where the Federal Reserve basically told us less than 3 rate cuts. So basically gave us 2. That's why I put this in, right, in the other video. That's why I was like, okay, if they give us 1 rate hike or fewer than 3 rate cuts, it's going to be the same thing. It's going to be almost an identical reaction in the market, which is going to be bearish. So these are the 3 things that we received today from the rate decision from 2023 and 2024. No hike today, 1 potential hike in 2023, and 2 rate cuts in 2024. That's the whole final sort of analysis. Now, like I said, market's reaction is bearish as expected. And I think the one big question I think they're going to ask is that inflation, your expectations for inflation is unchanged. In fact, it is lower for 2023 and next year is unchanged. Why then are you looking at fewer cuts in 2024, right? I think that's going to be one of the questions. Real GDP is expected to go up. Okay, so that makes sense. That probably makes sense because they are they're expecting a higher than previous June reading GDP growth, 1.5% versus 1.8. So, you know what? Let me just do this so it's a lot easier for us. Just gonna increase a little bit. Yeah. So I think that's one of the reasons why there are fewer cuts in 2024 priced in, because their 2024 GDP expectations are going up by 40 basis points. Now, think about it, and I want you guys to answer this, and brownie points for anybody who guesses it right. Why would they price in fewer cuts if they are expecting a higher GDP growth? I want everyone to answer, and I want more people to participate. Why fewer cuts if they are expecting higher GDP growth? Why would they do that? Why would they actually keep rates higher? Kendall says trying to slow the economy. That's close. Cool says fear of recession. Keep inflation from coming back. That's a good guess. More spending, sticky inflation. Dollar strength to have a cool down economy, slow the economy because the market is still strong. Roshan almost got it, which was close, because the economy is still strong and the economy can handle higher rates for longer, right? So that's basically the whole premise behind fewer cuts, is their expectation for GDP has gone up significantly. It's more than doubled, right? It's gone from 1 to 2.1%. That's a pretty sizable move. And for 2024, their expectations gone from 1.1 to 1.5%. So if the Federal Reserve is thinking that GDP is going to grow at a much faster rate than what they actually assumed in the past, then they're actually believing that economy can handle higher rates for longer. And that's why they plan to keep rates above 5% in 2024 as well. That's why fewer cuts in 2024. Even though inflation's expectations are 2.6%, which, obviously is nowhere near close to the Fed's target. It's close to the Fed's target, but it's not there yet. But of course, they're expecting higher rates for longer, 5.1%, which is pretty dramatic. And of course, 2025, they're also expecting rates higher at 3.9%. So if you take a look at the summary of this FedWatch tool, markets here, again, they did sell off a little bit, but they are starting to kind of be flat. You know what's interesting? What's interesting is the market expectations have completely been, they've been now, from what I know, they've been wrong on two different fronts. First, markets expecting no more rate hikes. The Federal Reserve's penciled in, once again, one more rate hike potential. And for next year, the market was pricing in 3 rate cuts. Initially, they were pricing in 4. Now they're 3, and now the Federal Reserve has told us 2. So it is just incredible how the market's been, and the Federal Reserve has been back and forth with each other. So Kevin says the market's priced in all of this already. I don't know. I doubt that they have, because if you come over to the probability section, you see 3 rate cuts is what they're pricing in. 2024, a terminal rate of 4.5 to 4.75, and now Federal Reserve is telling us 5.1. So 5.1 and 4.5, there's a pretty big gap there. There's a pretty big discrepancy, right? The spread is 60 basis points. That's a little over 2 hikes. So I don't know if the market's kind of fully on board with this Federal Reserve's forecast, because not only are we not pricing in a hike this year, we're also pricing in more cuts in 2024, even though the Federal Reserve told us no cuts this year and only 2 cuts now, next year in 2024, according to their brand new SEP. I'm kind of surprised to see the dot plot, because I was thinking it was going to be a close call between, the number of members kind of vote for or expect rates to be higher this year one more time, but it was pretty strong majority. 12-7 is a pretty big majority. I was hoping for like 10-9 or 11-8, but ended up being a pretty strong majority there for one more hike. So what if there are 2 cuts, but they are 50 basis points? So every cut and every hike is basically just 25 basis points, right? So if they're doing a bigger hike or bigger cut, they would mention that in their SEP, right? So right now their SEP pretty much says And it just doesn't really, I mean, the math won't math, right? The math won't work according to that analysis because they have pretty much given us the number, right? So we don't have to guess. We don't have to guess whether the cut's going to be 50 or 25. They've pretty much given us the number. It's 5.1. And coming from 5.6 to 5.1, that's a 50 basis point, right? So that's going to be 2 cuts of 25 each or 1 big cut of 50. Whereas the market is already pricing in 3 cuts, all the way down to 4.5 to 4.75%. So that's, that's where we are, and we'll take a look at, what Jerome Powell has to say. I think he is going to mention this. Let's bet on this, but I feel like he is going to mention that the reason for the fewer cuts in 2024 is because of the stronger than expected economic growth in GDP. Unemployment continues to be strong. I think that's also a factor playing a role because they see unemployment rate only at 3.8% by the end of this year, right? Initially it was 4.1. For next year, that's also a big decline, 4.1. So the fewer cuts are coming because of a stronger economy, because of a growing economy, and because of a tighter labor market. They're not coming on the back of inflation because inflation's still the same. It's unchanged for 2024. So why would they go with fewer cuts? I think it's because economy is very strong. Isn't it crazy that this literally tells me that the Federal Reserve made it their objective to break the economy? This literally tells you, like, these 4 numbers right here tell you the Federal Reserve have made their objective to break the economy. Because why else would they have fewer cuts if there's no change in inflation? They have literally no change in inflation expectations for next year, and yet they go with fewer cuts. Why? Because the economy is strong. Labor market's tight. So the math won't math. Time pass, how much percentage of your portfolio do you want Enphase to be? I haven't looked at it in a percentage basis yet, but I do know that I want to own several hundred shares. But I will definitely let everybody know in the Discord when I do actually start buying a little bit more aggressively. But yeah, I mean, I do want to buy more. Historically, what are the cuts after recession? Are they not steep cuts? So yes, I mean, the Federal Reserve takes staircases up and then elevators down when it comes to rate cuts and rate increases. They do them slowly and steadily, kind of on pace with the economy. But when it comes to the recessions, when it comes to the economy starting to slow down, they do them very, very quickly in anticipation of supporting that economy because, they need to do that very quickly. So yeah, on the way down, they go down to 0% like that. But on the way up, they go up over a course of a lot of months, right? 12, 18 months. 2-year yield. Yeah, let's take a look at the bond yields here. So what do we got? 4.35% on the 10-year. The 2-year sitting at 5.1%. 1 year sitting at 5.4%. Let's just come over to some of these yields. The yield on the 2-year sitting at 5.1%. This is the highest level going back as far as 2006. So this was literally just few months before, everything started going crazy. But we've got the 2-year sitting at the highest level since 2006, 17 years. US 10-year also at a very, very high level at 4.35%. We got the US 1-year sitting at a little bit over 5.485. Almost at 5.5%, right? So pretty aggressive move to the upside for all these yields. Everyone, vote. We are at 300 votes. So thank you so much for joining in our poll. But I will close this poll in the next 10 minutes. So I want more participation, and definitely do drop a like if you can. I would really appreciate it. And let's see if you have any questions on the macroeconomics, any questions on, what just happened with the Federal Reserve, or what's going on with the guidance, or what are they planning to do. I'm here to help you. I'm here to answer all questions. And just, let me know if there's any stock questions, any company questions, technicals, fundamentals, macros, psychology, whatever it is, throw them at me. But be more specific, right? So I can actually help you. So if you have any questions on any stocks, be as specific as possible. Will you be adding TMF here? Load up on TMF. So I actually did a video on TMF and TLT. Did that one go out? Did you guys watch that one? I did a video literally today on the biggest short, 600 billion. I don't know when I scheduled that for, but I think it might have gone out. I addressed TLT and TMF in that video as well. I mentioned that specifically. Can someone check if that video was already released. But I go over TLT and TMF in that video, specifically going over what my plan is. So I would encourage you to check that out if you haven't already. Okay, so I'm going to try to answer as many questions as possible. Do you think it's possible if you have already been in a recession? Well, I guess technical recession, yes, but not an economic one, because economic one, I think it is more to do with unemployment. Technical recession, I say that because GDP did contract a couple of quarters in a row. Earnings recession, we did see one because earnings did contract a couple of quarters in a row, but we never really saw that materialize into anything else because the labor market was so tight, right? That's one of the things that I've mentioned before is as the labor market, the unemployment numbers, that's the biggest marker. That's the most important marker for kickstarting a recession, right? As long as the labor market's good and it's tight and it's strong, there's no ripple effect. Nothing really spills over, right? I don't have that chart with me right now. I wish I did. But I did a video basically going over the unemployment numbers at the bottom. And then it was like a triangle, right? It was like a pyramid where at the very top, it was like an economic recession. So kind of going over in chronological sense how that plays out. Unemployment leads to less spending, leads to less earnings, leads to less hiring, leads to higher unemployment, leads to delinquencies, leads to lower economic growth, which leads to recession, right? So it all starts with unemployment. All starts with the jobs market, right? If it's tight, people are still going to be able to make their ends meet. They're going to be able to service their debt. They're going to be able to live and be fine. But as long as unemployment's strong, the moment it breaks, the entire system falls apart. It takes time, but that's what happens over time. So hopefully that answers your question a little bit. So we did, again, technically we did see a recession, but not from an economic standpoint. Also, I was in Dubai for a week. Wanted to write you on Insta to catch up. Maybe next time I write you on Insta when I'm there. Yes, please do that. And we'll love to get in touch with you. We'll definitely we'll love to take you out for dinner, drinks, whatever, coffee. We'll do that. So what will be the impact of what was released on the dollar and currencies? So great question. I think the dollar right now, I think should be moving a little bit higher, slightly down, more or less flat, but we are coming up to a big resistance on the DXY. So, this has been the range within which it's been trading at, and this is the first week in 1, 2, 3, 4, 5, 6, 7, 8, 9. In 9 weeks, this is the first week the dollar is down 23 basis points. So I think it makes sense that it starts to kind of move sideways a little bit. At 105, 106, we've been consolidating sideways. That's the resistance that we are at for the dollar. Support level is going to be closer to about 100. And, the dollar strength, I think a lot of it depends on the supply of debt. And we know that the fiscal debt continues to increase at over $33 trillion. So, that's something to keep in mind for the dollar as well. How do I see the videos you posted yesterday? I can't see them. I'm your Patreon. So, Nad, if you go on Discord, you should be able to go to MoneyVest videos. And there's the channel where our Red Mike robot posts all the video links every single day. So you can go there and check out all the videos that I've already posted on the channel. So you can pretty much go directly to the links. Could you do a video on SoFi projections? You'll be profitable in the next quarter. Yes, Lee, I was actually planning on doing a video on SoFi very soon. So I'm going to do that in the coming days, a video on SoFi. Right now, seems like it is down 75 basis points, but support level is going to be at around just under $8. But yes, I will be doing a video on SoFi very soon. Okay, NASDAQ here starting to bounce back higher a little bit, 37 basis points. We got the S&P flat. We got the Dow Jones here slightly up over 42 basis points. But bottom line is we are very, very flat at the moment, waiting on Jerome Powell. He's going to come on board in under 11 minutes, guys. So in 11 minutes, we're going to see Jerome Powell's press conference. I'm going to do an audio test in about 8 minutes or so. So you guys can tell me if audio video works well, and then we'll have the markets in the background. We'll take a look at the reaction to what Jerome Powell is saying as well. Compare on Solar Edge in comparison to Enphase, and Solar Edge inverters are cheaper than Enphase. So Prashant, I think, yes, they are cheaper, but I do believe that Enphase has a stronger moat with respect to technology and the way it works in terms of efficiency. But overall, I am bullish on the solar sector. It's been under a lot of pressure in 2023. And of course, you can see the margins are also significantly better for Enphase than they are for Solar Edge, right? Only 8% 9 to 8% margins. This year, it's last year was 3% in 2022. But for Enphase, of course, we are working with significantly higher margins at over 17, 18% for the company. So I like both in terms of like the industry growth, and I think they're both got a lot of potential. But I just prefer Enphase over any other solar company out there. Red tie. Should we do that poll? Should we do like what tie he's going to be wearing? All right, so I'm going to end this poll. 68% of you expect Jerome Powell to actually be hawkish during this meeting. I don't doubt that. I think that's going to be the case because he wants to make sure the market knows that he is serious about bringing inflation back down to the target. But even though the inflation expectations are unchanged, rate cuts are going down because of a stronger economy and a stronger jobs market. But let's just do a quick poll. Powell's tie color. Red, blue. I don't think he's ever worn a green tie. But we're going to put green just for the brave people out there. And I don't think he's going to put black on there. But I think those are the main colors, right? I don't think he's going to wear anything else like gray or... Right? I mean, I think those are pretty good. Like red, blue. I think blue and red has been pretty much what he's worn. This is just for fun, guys. All right? So don't take it too seriously. So we'll just do that poll. And we are ready. Did you take a look for STEM before? It's solar company also. I have not. STMEM. I'll see if I can do some analysis on this. Doesn't seem like it's profitable though. Down 47%. Energy storage system, hardware, ongoing software. So I'll add it to the watch list. And then I'll see if I can do an analysis on them in the future. So right now, of course, in a significant downtrend, lower highs and lower lows as well. Letty, thank you so much. I appreciate that very much. Coming from New Delhi, so that's great. I hope you enjoyed your stay in New Delhi. Black tie like his thoughts on Dollar General seems to be finding a bottom. So yes, I will be doing a video on Dollar General and Dollar Tree as well. Those are those two companies, DLTR. They've been selling off quite aggressively because, of course, their consumer demographics is significantly different than that of Costco and Target and some of the other companies out there. So they definitely do target people, consumers that on average are making less than $40,000. So in a environment where inflation's high, and of course economy is starting to slow down and people are shifting their spending, Dollar Tree and Dollar General are definitely struggling a little bit on that regard. So we'll be doing an update. I actually did a video on Dollar General not too long ago, so you can check that out if you haven't already. But I will be talking about this in more detail, doing a comparison with Dollar Tree as well. So Square here is having a brutal day, down 2.4%. Folks, this is something that I mentioned in one of my other videos. Actually, one of the comments that I mentioned was that every trade that you take, right, you're never going to have 100% win rate. That's something that you have to accept over time as a trader, as an investor. Not all your stocks are going to turn out to be winners, okay? In fact, quite the contrary, right? Most of your stocks are actually going to not perform. And that's what Warren Buffett also mentioned once, is that as an investor, you only have to get few things right? And our job is to avoid, of course, majority of the times, the losses that come with investing and trading. That's why we employ proper risk management. And Square, I agree, was one of the trade ideas. It did push higher for 1 week. It was up a little bit over 4%. And then, of course, last 3 weeks have been brutal. Started breaking down below that support. Sub $50 is a 3-year low for Square. And as unfortunate as it is, next support is going to be $34.50. Square for me has never been a long-term investment. I've only been interested in PayPal because, we've talked about the fundamentals. PayPal's got significantly better profits and cash flows as opposed to Square, which of course, majority of the revenue comes from Bitcoin, and margins are not that great. And it's also generating losses. So it's never been a long-term position. I've never really bought Square from the long-term perspective, but next support, unfortunately, is going to be $34.50. We'll revisit this. Of course, we'll analyze it. The lower it gets, the better, the sweeter the deal becomes. But I want to see profitability. I want to see consistency and profitability before it starts to become a attractive stock from a long-term perspective. But right now, only a trade. Breakdown, stop loss gets hit, you are out. And that's really the whole idea. Kevin says Square has no moat. Debatable again. I'm sure. I mean, it's kind of like very similar to PayPal, right? But you're right. I think fintech is very saturated to begin with, right? There's a lot of fintech companies. What mode does SoFi have, Kevin? Huh? You trying to start a fight? No, I'm just kidding. I love SoFi. SoFi is one of my favorite companies. DE looks really good here. I think there is deep value growth. So John Deere, let's see. Lots of consolidation getting rejected at that resistance at 444, 1.35% yield. I would really like it at 320s, to be honest, Frank. I think that would be a very strong support. That would be a great level at $320 for John Deere. Okay. I'm going to do an audio check as soon as this thing starts in less than 3 minutes now. 4 minutes, actually. Or 3 minutes now. So we're going to do an audio check. And you guys let me know if everything is working well. I'm going to pull this out. I'm going to keep this in the corner with Jay Powell. And then we'll also put in the markets over here. For everyone who is just joining us, thank you so much for joining. Drop a like, subscribe to the channel. But this is what really happened in the last 30 minutes or so. We got no hike from the Federal Reserve as expected. There was over a 99% probability the Federal Reserve is going to keep the rates unchanged. That's exactly what happened. But when it comes to the guidance for 2023, same thing. One more potential rate hike expected later this year, either in November or December. And then for guidance for 2024, this is what ended up happening, that we got fewer than 3 rate cuts in 2024. Only 2 rate cuts now priced in 2024. So we basically got a neutral, bearish between those 3 things. And as a result, the markets are slightly lower, and now they're starting to recover back higher. This is, very, very typical from the market. The earlier move gets disappeared, and of course, markets getting bought up. But still, Nasdaq's down, S&P's flat, and the Dow Jones is slightly higher. So we're seeing a little bit of rotation out of tech over to more value. Okay, when it comes to the tie discussion, we got 57% red. Okay, 21% blue. I'm going to vote blue. I will vote blue. We'll see what happens in the next 2 minutes. But we'll see. 2 more minutes left. %68 expecting hawkish, by the way. How about TWKS? You spoke about them a while ago. Yes, they're on my watch list. Video is going to be coming out soon. Guys, there's so many stocks, right? I'm actually in the process of hiring a few people for equity analysis. So we'll be doing some more stock analysis, more PDFs and research reports. All that actually is going to be available on our Patreon for all of our members, by the way. So for all the members, big exciting stuff's happening. So I will be posting PDF reports, research reports on specific companies, going over their strengths and weaknesses and threats and vulnerabilities, opportunities, going over fair values, the analysis behind it. So you can download those PDFs for yourself. But of course, you just have to understand that they are subject to change because, obviously analysis changes very, very quickly because the markets are changing constantly. So, okay, if these numbers have no impact on the market, then what is the use of these numbers? They do have an impact on the economy, right? Maybe not so much on the markets, but they do have an impact on the economy. This is a clear example of how rate hikes have an impact on the economy, which obviously has an impact on the market. Maybe it's not seen right away, but it does over time. And I'm just gonna make sure that we're live here. So again, every single rate has gone up, 300, 400, 500 basis points in the last year. So it definitely does have an impact. Of course, markets like to get bought up here right after the numbers came out. So PDD, Frank, I did look at this company. There was an issue with that company that I was able to recognize. I was looking at them, but there was a specific reason why I did not analyze it. I can't remember exactly what it is. Let me see if I can find it. Yeah, what? Hold on. There was something that I was looking at that kind of ticked me off. They've got negative net debt. They've got, there we go. Guys, I'm going to do an audio check. Let me know if everything is working well. Give me a thumbs up, okay?
Good afternoon, everyone. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. We understand the hardship that high inflation. Price stability is the responsibility of the Federal Reserve. Without price stability, the economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. We've covered a lot of ground, and the full effects of our tightening have yet to be felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Looking ahead, we're in a position to proceed carefully in determining the extent of additional policy firming that may be appropriate. Our decisions will be based on our ongoing assessments of the incoming data and the evolving outlook and risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that economic activity has been expanding at a solid pace. And so far this year, growth in real GDP has come in above expectations. Recent readings on consumer spending have been particularly robust. Activity in the housing sector has picked up somewhat, though it remains well below levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our Summary of Economic Projections, or SEP, committee participants revised up their assessments of real GDP growth, with the median for this year now at 2.1%. Participants expect growth to cool, with the median projection falling to 1.5% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 150,000 jobs per month, a strong pace that is nevertheless well below that seen earlier in the year. The unemployment rate ticked up in August, but remains low at 3.8%. The labor force participation rate has moved up since late last year, particularly for individuals aged 25 to 54 years. Nominal wage growth has shown some signs of easing, and job vacancies have declined so far this year. Although the jobs to workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises from 3.8% at the end of this year to 4.1% over the next 2 years. Inflation remains well above our longer run goal of 2%, 4% over the 12 months ending in August, and that excluding the volatile food and energy categories, core PCE prices rose 3.9%. Inflation has moderated somewhat since the middle of last year, and longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. Nevertheless, the process of getting inflation sustainably down to 2% has a long way to go. The median projection in the SEP for total PCE inflation is 3.3% this year, falls to 2.5% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We are highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points. We see the current stance of monetary policy as restrictive, putting downward pressure on economic activity, hiring, and inflation. In addition, the economy is facing headwinds from tighter credit conditions for households and businesses. Range for the federal funds rate at 5.25% to 5.5%, and to continue the process of significantly reducing our securities holdings. We are committed to achieving and sustaining a stance of monetary policy that is sufficiently restrictive to bring inflation down to our 2% goal over time. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 5.6% at the end of this year, 5.1% at the end of 2024, and 3.9% at the end of 2025. Compared with our June summary of economic projections, the median projection is unrevised for the end of this year, but has moved up by a 0.5 percentage point at the end of the next 2 years. These projections, of course, are not a committee's decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. Given how far we have come, we are in a position to proceed carefully as we assess the incoming data and the evolving outlook and risks. Real interest rates now are well above mainstream estimates of the neutral policy rate, but we are mindful of the inherent uncertainties in precisely gauging the stance of policy. We're prepared to raise rates further if appropriate, and we intend to hold policy at a restrictive level until we're confident that inflation is moving down sustainably toward our objective. In determining the extent of additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keep keeping longer-term inflation expectations well anchored. It's essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you. Colby Smith with the Financial Times. What makes the committee inclined to think that the Fed funds rate at this level is not yet sufficiently restrictive, especially when officials are forecasting a slightly more benign inflation outlook for this year? There's noted uncertainty about policy lags. Headwinds have emerged from the looming government shutdown, the end of federal childcare funding, resumption of student debt payments, things of that nature.
So I guess I would characterize the situation a little bit differently. So we decided to maintain the target range for the federal funds rate where it is at 5.25% to 5.5%, while continuing to reduce our securities holdings. And we say we're committed to achieving and sustaining a stance of monetary policy that's sufficiently restrictive to bring down inflation to 2% over time. We said that. But the fact that we decided to maintain the policy rate at this meeting doesn't mean that we've decided that we have or have not at this time reached that stance of monetary policy that we're seeking. If you looked at the SEP, as you obviously will have done, you will see that a majority of participants believe that it is more likely than not that it will be appropriate for us to raise rates one more time in the 2 remaining meetings this year. Others believe that we have already reached that. So it's something where we're not making a decision by deciding to about that question, by deciding to just maintain the rate and await further data.
So right now, it's still an open question about sufficiently restrictive. You're not saying today that we've reached this level.
We're not saying, yeah, no, clearly what we decided to do is maintain the policy rate and await further data. We want to see convincing evidence, really, that we have reached the appropriate level, and you know, we're seeing progress, and we welcome that. But you know, we need to see more progress before we'll be willing to reach that conclusion.
And just on the 2024 projections, what's behind that shallower path for interest rate cuts and the need for real rates to be 50 basis points higher?
Right. So I would say it this way. First of all, real interest rates are positive now. They're meaningfully positive. And that's a good thing. We need policy to be restrictive so that we can get inflation down to target, okay? And we're going to need that to remain to be the case for some time. So I think, you know, remember that of course, the SEP is not a plan that is negotiated or discussed really as a plan. It's accumulation, really, and what you see are the medians. It's accumulation of individual forecasts from 19 people, and then what you're seeing are the medians. So I wouldn't want to, you know, bestow upon it the idea that that's really a plan. But what it reflects, though, is that economic activity has been stronger than we expected, stronger than I think everyone expected. And so what you're seeing is this is what people believe as of now will be appropriate to achieve what we're looking to achieve, which is progress toward our inflation goal, as you see in the SEP.
Thanks. Let's go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. How would you characterize the debate around another hike or holding steady? Is it discussion around lag times, fear of too much slowing, too little slowing? Could you walk us through what this disagreement was about at the meeting?
Yeah, so the proposal at the meeting was to maintain our current policy stance. And I think there was obviously unanimous support for that. But this, of course, is an SEP meeting, and so people write down what they think. And you have some, you saw, I think 7 wrote down no hike at this meeting, or between now and the end of the year, and I think 12 wrote down another single hike in one of the next 2 meetings that we have between the end of the year. So it wasn't like we were arguing over that. People were just stating their positions. And really what people are saying is, let's see how the data come in. You know, we want to see, you know what we want to see. We want to see that these good inflation readings that we've been seeing for the last 3 months, we want to see that it's more than just 3 months, right? We want to see, you know, the labor market report that we received, the last one that we received, was a good example of what we do want to see. It was a combination of across a broad range of indicators, continuing rebalancing of the labor market. So those are the 2 things. Those are our 2 mandate variables, and that's the progress that we want to see. But I think people, they want to be convinced, you know, they want to be careful not to jump to a conclusion really one way or the other, but just be convinced that the data, you know, support that conclusion. And that's why, given how far we've come and how quickly we've come, we're actually in a position to be able to proceed carefully as we assess the incoming data and the evolving outlooks and risks and make these decisions meeting by meeting.
And in your view, I know nothing has been decided yet, but what would one more hike at the end of the year do to the economy or to inflation? And on the other side, what would no hike do, if you could sort of game that out for us?
So, you know, you can make the argument that one hike one way or the other won't matter, but for us, we're trying, obviously as a group, it's a pretty tight cluster of where we think that policy stance might be, but we're always going to be learning from data. You know, we've learned all through the course of the last year that actually we needed to go further than we had thought. If you go back a year and what we wrote down, it's actually gotten higher and higher. So we don't really know and that's why, again, we're in a position to proceed carefully at this point. A year ago, we proceeded pretty quickly to get rates up. Now we're fairly close, we think, to where we need to get. It's just a question of reaching the right stance. I wouldn't attribute huge importance to one hike in macroeconomic terms. Nonetheless, you know, we need to get to a place where we're confident that we have a stance that will bring inflation down to 2% over time. That's what we need to get to, and we've been moving toward it. As we've gotten closer to it, we've slowed the pace at which we've moved. I think that was appropriate. And now that we're getting closer, we have the ability to proceed carefully.
Let's go to Steve.
Steve Leisman, CNBC. Mr. Chairman, I want to return to Colby's question here. What is it saying about the committee's view of the inflation dynamic in the economy that you achieve the same forecast inflation rate for next year, but need another 0.5 point of the funds rate on it? Does it tell us that the committee believes inflation to be more persistent, requires more medicine effectively? And I guess a related question is, if you're going to project a funds rate above the longer run rate for 4 years in a row, at what point do we start to think, hey, maybe the longer rate or the neutral rate is actually higher? Thank you.
So I guess I would point more to, rather than pointing to a sense of inflation having become more persistent, I wouldn't think that's not, we've seen inflation be more persistent over the course of the past year, but I wouldn't say that's something that's appeared in the recent data. It's more about stronger economic activity, I would say. So if I had to attribute one thing, again, we're picking medians here and trying to attribute one explanation, but I think broadly, stronger economic activity means rates, we have to do more with rates, and that's what that meaning is telling you. In terms of what the neutral rate can be, we know it by its works. We only know it by its works, really. We can't the models and the economy reacts. And again, that's another reason why we're moving carefully now, because there are lags here. So it may of course be that the neutral rate has risen. You do see people. You don't see the median moving, but you do see people raising their estimates of the neutral rate, and it's certainly plausible that the neutral rate is higher than the longer run rate. Remember, what we write down in the SEP is the longer run rate. It is certainly possible that that the neutral rate at this moment is higher than that, and that's part of the explanation for why the economy has been more resilient than expected.
Let's go to Howard.
Howard Schneider with Reuters. Thank you. So you've said several times that the economy needed a period of below trend growth to get inflation consistently back to 2%. You kind of get that in 2024, a little bit. 1.5% is just a touch below what's the estimate of potential. So the fact that you're getting so much done at so much less cost, does that represent a change in how you think inflation works, a change in how you think the economy works, a change in the mix of supply healing versus demand destruction that's necessary to achieve this?
Yes, of course, it is a good thing that we've seen now meaningful rebalancing in the labor market without an increase in unemployment, and that's because we're seeing that rebalancing in other places, in, for example, job openings, and in the jobs worker gap. You're also seeing supply side things, so that's happening. I would say though, I still think, and I think broadly people still think that there'll have to be some softening in the labor market that can come through more supply, as we've seen as well. Also, remember, the natural rate we think is coming down, which is a supply side thing, so that the gap between any given unemployment rate that's lower than that and the natural rate comes down. That's a way for that's a way for the labor market to achieve a better balance. So all of those things are happening. You're right. In the median forecast, we don't see a big increase in unemployment. We do see an increase. And but that really is just playing forward the trends that we've been seeing. That is not guaranteed. There may come a time when unemployment goes up more than that, but that's really what we've been seeing, is progress without higher unemployment for now.
So just to boil that down for a second, we've gone from a very narrow path to a soft landing to something different. Would you call the soft landing now a baseline expectation?
No, I would not do that. I would just say, what would I say about that? I've always thought that the soft landing was a plausible outcome, that there was a path really to to a soft landing. I've thought that, and I've said that since we lifted off. It's also possible that the path has narrowed and it's widened. Apparently, ultimately, this may be decided by factors that are outside our control at the end of the day. But I do think it's possible, and I also think this is why we're in a position to move carefully again. That we will restore price stability. We know that we have to do that, and we know the public depends on us doing that. And we know that we have to do it so that we can achieve the kind of labor market that we all want to achieve, which is an extended period, sustained period of strong labor market conditions that benefit all. We know that. The fact that we've come this far lets us really proceed carefully, as I keep saying. So I think, that's the end we're trying to achieve. I wouldn't want to handicap the likelihood of it, though. It's not up to me to do that.
Nick Timmeros of the Wall Street Journal. Chair Powell, both you and Vice Chair Williams have indicated that sufficiently restrictive will be judged on a real rather than nominal basis, implying some scope for nominal rate cuts next year, provided further compelling evidence that price pressures will continue to subside. Is the FOMC focused on targeting a real level of policy restriction? And can you explain what would constitute enough evidence that will allow the FOMC to normalize the nominal stance of policy while keeping real policy settings sufficiently restrictive?
I mean, yes, we understand that it's a real rate that will matter and that it needs to be sufficiently restrictive. Again, I would say, sufficiently restrictive only when you see it. It's not something you can arrive at with confidence in a model or in various estimates, And so what are we seeing? We're seeing, through a combination of the unwinding of the pandemic-related demand and supply distortions and monetary policy's work in suppressing demand or alleviating very high demand. The combination of those two things is actually working. You're seeing, inflation coming down. It's principally now in goods, also in housing services. You begin to see effects of it in non-housing services as well. So we think that is working. And I think as we've said, we want to reach that. We want to reach something that we're confident it gets us to that level. And I think confidence comes from seeing, enough data that you feel like, yes, okay, this feels like we can for now decide that this is the right level and just agree to stay here. We're not permanently deciding not to go higher, but we would, let's say if we get to that level. And then the question is, how long do you stay at that level? And that's a whole nother set of questions. For now, the question is trying to find that level where we think we can stay there. And we haven't gotten to a point of confidence about that yet. That's the stage of
this year. And even then, it seems possible the core PCE inflation could come in even lower than the median at 3.7%. Would you see a case to raise rates still if it turned out that you were going to achieve the same real rate this year because the decline in inflation proceeds somewhat better than you currently anticipate?
The decision that we make at each meeting, and certainly at the last two meetings this year, it's going to depend on the totality of all the data. So the inflation data, the labor market data, the growth data, the balance of risks and the other events that are happening out there. We take all of that into account. So I can't really answer a hypothetical about one piece of that. It'll be trying to reach a judgment over whether we should move forward with another rate hike overall, and whether that would increase our confidence that yes, this is an appropriate move, and it will help us be more confident that we've gotten to the level that we need to get to.
Gina?
Thanks, Chair Powell. Following up on Nick's question, actually, John Williams, the New York Fed president, obviously, has said things to the effect of next year, as we see inflation kind of, again, to Nick's point, as we see inflation coming down, we're going to need to reduce interest rates to make sure that we're not squeezing the economy harder and harder over time. And I wonder if that's basically the logic that you apply, is that how you think about it? And then I also wonder, in the last press conference, you said something to the effect of, it's a full year out, those discussions, and people interpreted that to mean that you didn't see a possibility of a rate cut in the first half of next year. And I wonder if that was what you meant by that, or whether, how you're thinking about that timing.
No, when I answer these questions about hypotheticals about cutting, I'm never intending to send a signal about timing. I'm just answering them as the question is expressed. So please, I wouldn't want to be taken that way. Sorry, the first question was that how? Yeah, so we're, as we go into next year, that's the question we'll be asking is, taking into account lags and everything else we know about the economy and everything we know about monetary policy. The time will come at some point, and I'm not saying when, that it's appropriate to cut. Part of that may be that real rates are rising because inflation is coming down. Part of it just may be that it'll be all the factors that we see in the economy. And, that time will certainly come at some point. And what you see is us writing down, a year ahead estimates of what that might be. And, there's so much uncertainty around that. When we, in the moment, we'll do what we think makes sense. No one will look back at this and say, hey, we made a plan. It's not like that at all. These are estimates made a year in advance that are highly uncertain, and that's how it is.
Neil.
Thanks so much, Chair Powell. Neil Irwin with Axios. Wonder, how do you think about the question of whether the strong GDP growth we've been seeing is driven by excess demand versus supply side factors, productivity, labor force growth? And relatedly, if GDP keeps coming in hot, even in the absence of inflation resurgence, would that on its own be a reason to consider more tightening?
So on your first question, we're looking at GDP very, very carefully to try to understand really what's the direction of it, what's driving it, and it's a lot of consumer spending. The consumer's been very robust in spending. So that is, that's how we're looking at it. Sorry, your second question was?
There's GDP stays hot, but without inflation.
So I think the question will be, GDP is not a mandate, right? Maximum employment and price stability are the mandates. The question will be, is the heat that we see in GDP, is it really a threat to our ability to get back to 2% inflation? That's going to be the question. It's not a question about GDP on its own. It's you're expecting to see this improvement, continued rebalancing in the labor market and inflation moving back down to 2% in a sustainable way. We have to have confidence in that, and we'd be looking at GDP just to the extent that it threatens one or both of those.
Victoria.
Hi, Victoria Guida with Politico. There are multiple external factors that are playing out right now. We see rising oil prices. We see auto workers striking. There's the looming, very real possibility of a government shutdown. And I was just wondering, for each of those things, could you talk about how you're thinking about how that might affect the course for the Fed and the economy?
So there is a long list, and you hit some of them. But it's the strike, it's government shutdown, resumption of student loan payments, higher long-term rates, oil price shock. There are a lot of things that you can look at. So what we try to do is assess all of them and handicap all of them. And ultimately, though, there's so much uncertainty around these things. To start with the strike, first of all, we absolutely don't comment on the strike, as we have no view on the strike one way or the other, but we do have to make an assessment of its economic effects to do our jobs. So, the thing about it is so uncertain. It will depend. The economic effects, it could affect, we've looked back at history, it could affect economic output, hiring, and inflation, but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain and but that's really going to depend on how broad it is and how long it's sustained for. And then it also depends on how quickly production can make up for lost production. So none of those things are known right now. It's very, very hard to know. So you just have to leave that uncertain, and we'll be learning, I think, over the course of the next intermeeting period. It hasn't traditionally had much of a macroeconomic effect. Energy prices being higher, that is a significant thing. Energy prices being up can affect spending. It can affect over time a sustained period of higher energy prices can affect consumer expectations about inflation. We tend to look through short-term volatility and look at core inflation. But so the question is, how long are higher prices sustained? We have to take those macroeconomic effects into account as well. Those are some of them. I'm not sure if I hit them all, but I mean, ultimately, you're coming into this with an economy that appears to have significant momentum, and that's what we start with. But we do have this collection of risks that you mentioned.
Greg Torres from Bloomberg News. I was a little surprised, Chair Powell, to hear you say that a soft landing is not a primary objective. This economy is seeing added supply in a way that could create long-term inflation stability. We have prime age labor force participation moving up where people can add skills. Workers want to work. We have a boom in manufacturing construction. We've had a decent spate of home building. And since inflation's coming down with strong GDP growth, we may have higher productivity. All are which good for the Fed's longer run target of low inflation. And if we lose that in a recession, aren't we opting for the awful hysteresis that we had in 2010? So are you taking this into account as you pursue policy? Thank you.
To begin, a soft landing is a primary objective, and I did not say otherwise. I mean, that's what we've been trying to achieve for all this time. The real point, though, is the worst thing we can do is to fail to restore price stability, because the record is clear on that. If you don't restore price stability, inflation comes back, and you go through, you can have a long period where the economy is just very uncertain, and it'll affect growth, it'll affect all kinds of things. It can be a miserable period to have inflation constantly coming back and the Fed coming in and having to tighten again and again. So the best thing we can do for everyone, we believe, is to restore price stability. I think now, today, we actually, we have the ability to be careful at this point and move carefully, and that's what we're planning to do. So we fully appreciate the benefits of being able to continue what we see already, which is rebalancing in the labor market and inflation coming down without seeing, an important, large increase in unemployment, which has been typical of other tightening cycles. So.
Go to Chris.
Hi, thank you. Chris Rugaber at Associated Press. When you look at the disinflation that has taken place so far, do you see it mostly as a result of what some economists are calling the low-hanging fruit, such as the unwinding of supply chain snarls and other pandemic disruptions, or is it more a broad disinflationary trend that involves most goods and services across the economy? Thank you.
So if I understood your question, I would say it this way. I think we knew from before when we lifted off, but certainly by the time we knew that bringing inflation back down was going to take, as I call it, the unwinding of these distortions to both supply and demand that happened because of the pandemic and the response. So that unwinding was going to be important. In addition, monetary policy was going to help. It was going to help supply side heal by cooling demand off, and just in general, better aligning supply with demand. So those two forces were always going to be important. I think it's very hard to pull them apart. They work together. I do think both of them are at work now, and I think they're at work in a way that shows you the progress that we are seeing.
Go to Mike.
Michael McKee from Bloomberg Television and Radio. In June, you forecast a 5 would justify that last move because the median forecast is for lower inflation. And given all the known unknowns that you face, how much confidence do you have, can investors have, or the American people have in your forecasts?
Well, forecasts are highly uncertain. Forecasting is very difficult. Forecasters are a humble lot with much to be humble about. But to get to your question, though, what's happened is growth has come in stronger, right? Stronger than expected, and that's required higher rates. Unemployment, you also see that the ultimate unemployment rate is not as high, but that's really because of what we've been seeing in the labor market. We've seen more and more progress in the labor market without seeing significantly higher unemployment. So we're continuing that trend. In terms of inflation, you are seeing the last three readings are very, very good readings. It's only three readings. You know, we were well aware that we need to see more than three readings. But if you look at June, July, and August, you're looking at, you know, really significant declines in core inflation, largely in the goods sector, also to some extent in housing services, and just a little in non-housing services. Those are the three buckets. Headline inflation, of course, has come way down, largely due to lower energy prices, some of which is now reversing. So I think people should know that economic forecasting is very difficult, and these are highly uncertain forecasts. But these are our forecasts. We have very high quality people working on these forecasts, and I think they stand up well against other forecasters. But just the nature of the business is the economy is very difficult to forecast.
Given the forecast that you have, what justified not moving today, and what could justify moving in the future if you think?
I think we have come very far, very fast in the rate increases that we've made. And I think it was important at the beginning that we moved quickly, and we did. And I think as we get closer to the rate that we think, the stance of monetary policy that we think is appropriate to bring inflation down to 2% over time, you know, the risks become more two-sided. And the risk of over-tightening and the risk of under-tightening, it becomes more equal. And I think the natural common sense thing to do is, as you approach that, you move a little more slowly as you get closer to it. And that's what we're doing. So we're taking advantage of the fact that we have moved quickly to move a little more carefully now as we sort of find our way to the right level of restriction that we need to get inflation back down to 2%.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. With your focus on year-over-year PCE, isn't it true that base effects are huge, and that by the time you meet in November, that it's more likely that you'll have a low PCE number that would make you feel more comfortable? And secondly, how would the lack of key indicators like CPI, the jobs report, impact your approach in upcoming meetings if we were to have a government shutdown? Thank you.
Yeah, I missed the first question. What was what factors?
The base factors.
Base factors, okay. So on that, we're looking at just monthly, right? You can look at just monthly readings and see what the increase was from the prior month. So you're right, when you go back 3, 6, and 12 months, you get base factors, but we can adjust for that. In terms of not getting data, again, we don't comment on government shutdowns. It's possible if there is a government shutdown and it lasts through the next meeting, then it's possible we wouldn't be getting some of the data that we would ordinarily get, and we would just have to deal with that. And I don't know. It's hard for me to say in advance how that would affect that meeting. It would depend on all kinds of factors that I don't know about now, but it's certainly a reality that's a possibility.
As those kind of fall out of the equation for the next couple of readings by November, would you feel more comfortable at that point?
Yes. I mean, if you're looking, if we can tell how much inflation has gone up in a given month, right? And that's what we're looking at. And month by month, what's the reading? And I think what we're really looking at is there's a tendency to look at shorter and shorter maturities, but they're incredibly volatile and they can be misleading. That's why we look at 12-month. But I think in this situation where it looks like we've had a bit of a turn in inflation starting in June, we're also looking at 6 months and even 3 months, but really 6 months inflation. So you're looking at it over that period and over longer periods. That's the right way to go. And we don't need to be in a hurry in getting to a conclusion about what to do. We can let the data evolve.
Thanks for the question, Chair Powell. Edward Lawrence with Fox Business. So I want to focus back in on oil prices. We're seeing oil prices, as you mentioned, move up, and that's pushing the price of gas. So how does that factor into your decision to raise rates or not? Because the last two inflation reports, PCE and CPI, we've seen the overall inflation has actually risen.
Right. So, energy prices are very important for the consumer. This can affect consumer spending. It certainly can affect consumer sentiment. I mean, gas prices are one of the big things that affects consumer sentiment. it really comes down to how persistent, how sustained these energy prices are. The reason why we look at core inflation, which excludes food and energy, is that energy goes up and down like that, and it doesn't. Energy prices mostly don't contain much of a signal about how tight the economy is, and hence don't tell you much about where inflation's really going. However, we're well aware though that if energy prices increase and stay high, that'll have an effect on spending, and it may have an effect on consumer expectations of inflation, things like that. That's just things we have to monitor. So.
On the consumer, they're putting more and more of this on their credit card. The consumer seeing, record credit spending. How long do you think the consumer can manage that debt at higher interest rates now? And are you concerned about a debt bubble related to that?
So, to finish my prior thought, I was saying that's why we tend to look through energy moves that we can see as short-term volatility. Turning to consumer credit, of course, we watch that carefully. Consumer distress, measures of distress among consumers were at historic lows quite recently, during and after the pandemic. They're now moving back up to normal. We're watching that carefully. But at this point, these readings they're not at troublingly high levels. They're just kind of moving back up to what was typical in the pre-pandemic era.
Hi, Jean Young with M&I Market News. Yields along the Treasury curve have risen to their highest in years. What is the Fed's view about what's been driving that increase in recent weeks, and how much of it can be attributed to macro explanations and how much to technical factors?
So you're right. Rates have moved up significantly. I think it's always hard to say precisely, but most people do a common decomposition of the increase, and the view will be it's not mostly about inflation expectations. It's mostly about other things, either term premium or real yields, and it's hard to be precise about this. Of course, everyone's got models that'll give you a very precise answer, but they give you different answers. So, but essentially, they're moving up because it's not because of inflation. It's because it'll probably have something to do with stronger growth. I would say more supply of treasuries. The common explanations that you hear in the markets kind of make sense.
Kyle Campbell, American Banker. Thank you for taking the questions. Just two on housing. You said slower shelter cost growth is in the pipeline and will reflect in inflation readings as new leases are signed. But there's also some questions out there about the way housing costs are measured, particularly the use of rental equivalents, which are estimates from homeowners about what their homes would rent for if they were in the rental market. So my question is, how much of the effort to tame inflation, both as it's measured and felt by the broader public, hinges on housing supply? And then as far as a constrained housing supply being sort of exacerbated by this sort of lock-in effect of mortgages being higher now than they were at their recent historic lows, how is that going to impact future thinking about taking interest rates to that lower bound in the future?
So on the supply point, of course, supply is very important over time in setting house prices and for that matter rents, and supply is kind of structurally constrained. But in terms of where inflation's going in the near term, though, as you obviously know, a lot of it is leases that are running off and then being re-signed or released at a level that's it won't be that much higher. A year ago it would have been much higher than it was a year before. Now it may be below or at the same level. So as those leases are rolling over, we're seeing what we expect, which is measured housing services inflation coming down. Your second question was the lock-ins. How much is that affecting things, really?
Is that going to affect your decisions to potentially bring rates down to their lower bound in the future, sort of creating that sort of bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages, and even if they want to move
bubble of buying and then a lock-in that sort of stagnates the housing market?
I think we look at I would look at the lock-in, the idea being that people are in very low rate mortgages. And even if they want to move now, it would be hard because the new mortgage would be so expensive. Play a role in our future decisions in a future loosening cycle about whether we would cut rates? No, I don't think it would. I mean, I don't think that's. I think we'd be looking at what fundamentally what rates does the economy need, and in an emergency like the pandemic or during the global financial crisis, you have to cut rates to the point that you have to do what you can to support the economy. So I wouldn't think that would be a reason for us not to do that. It's not something we're thinking about at all right now, but down the road I wouldn't think so.
Hi, Nancy Marshall-Genzer with Marketplace. Chair Powell, you've mentioned several things that would possibly weigh on consumer confidence, maybe cut back consumer spending, possible government shutdown, high gas prices. At this point, would the Fed welcome a decrease in consumer spending? Would that help you get inflation closer to your 2% target?
I wouldn't say it that way. We're not looking for a decrease in consumer spending. It's a good thing that the economy is strong. It's a good thing that the economy has been able to hold up under the tightening that we've done. It's a good thing that the labor market's strong. The only concern, and it just means this: if the economy comes in stronger than expected, that just means we'll have to do more in terms of monetary policy to get back to 2%, because we will get back to 2%. Does that answer your question?
Yeah, and I guess on the other hand, would you worry that that could contribute to an economic slowdown or even a recession?
Well, that's always a concern. I mean, concern number one is restoring price stability, because in the long run, that's something we have to do so that we can have the kind of economy we really want, which is one with sustained period of tight labor market conditions that benefit all, as I've said a couple times. So that said, of course, we also now, given how far we've come with our rate hikes and how quickly we've come here, we do have the ability to be careful as we move forward because of that consideration.
Thank you, Chair Powell. Simon Rabinovich with The Economist. One of the factors in the economic resilience to date appears to be a lesser degree of rate sensitivity than in the past. Obviously, we've talked about households with long fixed rate mortgages, also companies that refinanced before last year. What is your thinking about the efficacy of rates and how that's changed? And then related to that, how do you think about the distributional consequences, in the sense that if you're a relatively wealthy household with a long fixed rate mortgage, the past year has not been all that tough with rates going up, whereas if you're relying on your credit card for supporting your consumption, in fact, times are getting a lot tougher, a lot more quickly. Thanks.
So I guess it's fair to say that the economy's been stronger than many expected, given what's been happening with interest rates. Why is that? Many candidate explanations. Possibly a number of them make sense. One is just that household balance sheets and business balance sheets have been stronger than we had understood, and so that spending is held up and that kind of thing. We're not sure about that. The savings rate for consumers has come down a lot. The question is whether that's sustainable. It could just mean that the date of effect is later. It could also be that for other reasons, the neutral rate of interest is higher for various reasons. We don't know that. It could also just be that policy hasn't been restrictive enough for long enough. And there are many candidate explanations. We have to, in all this uncertainty, make policy. And I feel like what we have right now is what's still a very strong labor market, but that's coming back into balance. We were making progress on inflation. Growth by many forecasts, many forecasts call for growth to moderate over the course of the next year. So that's where we are, and we have to deal with what comes. On your second question your second question was distributional, but can you be a little clearer about that?
Yeah, my point there was that if you're somebody who has a long fixed rate mortgage, you've been able to endure the higher rates relatively easily. If you're somebody who's living month to month off of your credit card, current financing rates are punitive.
Yes, and so the point I would make there is that we're trying to get inflation back down. The people who are most hurt by inflation are the people who are on a fixed income. If you're a person who spends all of your income, you don't really have any meaningful savings. You spend all your income on the basics of life: clothing, food, transportation, heating, the basics. And prices go up by 5, 6, 7%. You're in trouble right away. Whereas even middle class people have some savings and some ability to absorb that. So it is for those people, as much as for anybody, that we need to restore price stability. And we want to do it as quickly as possible. Obviously, we would like to do that. We'd like the current trend to continue, which is that we're making progress without seeing the kind of increase in unemployment that we've seen in past things. But you're right, though. When we raise rates, people who are, who are living on credit cards and borrowing are going to feel that more. They are. And of course, people with lots of savings also have a much lower marginal propensity to consume, and so it's not going to affect them as much.
Let's go to Greg Robb for the last question.
Thank you, Chair Powell. Greg Robb from MarketWatch. In the Beige Book recently, you can tell that the Fed has been surveying nonprofits and community groups about the economic health of low-income Americans, moderate-income Americans. I have two questions about this. Are you going to use that data to maybe come up with sort of like a quarterly survey of those groups, like the Senior Loan Officer Survey? And and also the second question is, from your recent readings of these surveys, how are low and moderate Americans doing? Is there this thing where like the GDP is strong because of wealthy Americans kind of driving things? And just want to get your sense of the health of that sector. Thank you.
So I don't know about the quarterly survey. That's an idea we can take away and think about. In terms of how low and moderate Americans, they're clearly we're suffering from high inflation. I think during the pandemic, the government transfers that happened were very meaningful. And if you know the surveys that we take showed that low and moderate income people were actually in very, very strong financial condition. I think now it's a very hot labor market, and you're seeing high nominal wages, and you're starting to see real wages are now positive by most measures. So I think overall households are in good shape. Surveys are a different thing. So surveys are showing dissatisfaction, and I think a lot of that is just people hate inflation, hate it. And that causes people to say the economy is terrible, but at the same time, they're spending money. Their behavior is not exactly what you would expect from the surveys. That's kind of a guess at what the answer might be. But I think there's a lot of good things happening on household balance sheets, and certainly in the labor market and with wages. The biggest wage increases having gone to relatively low wage jobs, and now inflation coming down, you're seeing real wages, which is a good thing. Thanks very much.
All right, so overall, I would say, yeah, so you guys can hear me, see me? I just want to make sure that is good. So yeah, overall, I would say it was a little bit more leaning towards the hawkish side. The Federal Reserve has made themselves very clear that they are very determined to obviously bring inflation back down to 2%, but also at the same time break the economy in the process if that what is needed, because he pretty much mentioned that GDP is not the mandate, and of course inflation and unemployment is. And obviously if GDP starts to roll over, unemployment will follow, because it doesn't take long before unemployment starts to break if GDP is not growing and if you're starting to see contractions in economic growth. I think the variety of questions was pretty good. I think we covered the increase in yields, inflation, and that's exactly what he mentioned. Remember when he was asked, why fewer rate cuts when you are expecting a same inflation number in 2024? what did he say? He said a stronger economic growth, better than expected economic growth, and a very tight labor market is the reason why we are expecting fewer rate cuts and higher rates for longer in 2024. So that's, pinpointed to exactly that. Obviously soft landing is still in their baseline expectation. That's still their primary objective, but it's not like a baseline expectation, right? So that one guy was trying to put words in his mouth, which obviously he cleared up later, basically saying that, primary objective still is soft landing. But of course it's not in their baseline expectation, because they do expect, it's a plausible outcome, but it's not their baseline expectation. So overall, I would say it was a pretty good meeting. Obviously, markets here selling off on the fact that we did see 2 neutrals and 1 bearish in terms of guidance. So this right here, again, if you come back, this is what actually transpired. No hike this meeting. 1 rate hike potentially for 2023. That's going to depend, once again, on the data, the cumulative totality of data with inflation, unemployment, and the GDP numbers. And guidance for 2024 changed to fewer than 3 rate cuts, only 2 rate cuts being priced in by the Federal Reserve, penciled in their summary of economic projections. So that's where we ended up being. NASDAQ here down almost 90 basis points. We've got the S&P down 46 basis points. The yields are once again a little bit higher, slightly down on 28 basis points here on the 10-year, but the 2 years pushed up 5.13%. It's been pushing higher. Got the 1 year, the 6 month, and 3 months. So the shorter end of the curve continues to push up. And again, the question was, why do you think the yields are pushing higher? The main reason he pointed out was because could be a stronger growth, or could be the supply of treasuries. And that's exactly what we have talked about in our videos. Multiple times I've mentioned that there's a significant issuance, corporate and government issuance of debt, right? As companies continue to raise capital through debt issuances, so does the government, right? Fiscal stimulus, fiscal policy is part of that. The Treasury Department continues to issue more bonds, and as a result, there's more supply. The market's appetite is not that high, and the yields continue to go higher, prices continue to go down. So until that normalizes, I think we are going to see yields push higher. I did a video on this earlier today, so do check that out. And that's going to answer your question related to TLT and TMF as well. Other things, I'm going to once again go over that, summarize it, and do a separate video, talk about that in more detail, everything that he talked about. But of course, their goal has not changed. Inflation is still their primary objective, bringing it down to 2%. And they are seeing a very, very strong economic growth, and of course, unemployment growth. Unemployment continues to be very tight. So thank you so much for joining, everyone. I really appreciate all of you. And yes, he did wear a purple tie, which I believe is a shade of blue. No, I'm just kidding. And he also mentioned when it comes to credit card debt, obviously some people pointed out that it's increasing, and the rate on the credit cards are also increasing to a point where it's now starting to become very very aggressive for consumers. But he mentioned that it's kind of from a, what did he say? He said we're kind of moving back to the pre-pandemic levels when it comes, distress surveys, right? So consumer distress surveys are basically moving back to the pre-pandemic levels. So according to the survey, I guess, consumers are not that stressed out. But we know what the real situation is. Of course, consumers are tapping into debt and, of course, credit cards to fund their lifestyle and fund their spending at the moment. So once again, thank you so much for joining, everyone. Make sure that you drop a like, subscribe to the channel, subscribe if you want to, again, be a part of our MoneyVest community. There's going to be links down below for our Discord, for our Patreon. We'd love to have you on board. I'm doing a lot of buying for individual stocks. A few of them I'm actually dollar cost averaging into. So again, if you want all the alerts, binds alerts, options alerts, trade ideas, everything's going to be included with members only private videos, and of course intrinsic value spreadsheets and our fair values on our shopping list and our stocks as well. So link's going to be down below. 16% annual discount that's available till the end of this month. Hope you all enjoyed this live stream. As always, take care, happy investing, and I will see you all in the next video. Yes, it's time to go to bed because it's pretty late over here. So take care.